Hey, TMFG community. Carlo here, and I'm joined today by John to talk about a question that we get all the time. How much do I really need to retire comfortably here in Canada? Spoiler alert, it's not always 3 million like the headlines say.
That's right. For years, Canadians have been told they need 3 million in a nest egg to retire comfortably. But here's the truth. That number is outdated, overly simplistic, and doesn't really consider how retirement income actually works here in Canada. It's often based on generic assumptions that ignore the nuances of government benefits, tax rules, and account structures that are unique to Canada.
Well, over the years, we've worked with hundreds of Canadian retirees and soon-to-be retirees from coast to coast. And the biggest insight? Most people are overestimating what they truly need, and that's sometimes by over $1 million. And that's a huge gap that can cause unnecessary stress and oversaving.
The problem is many folks aren't using the right strategies. There are Canadian-specific tax rules, government benefits like CBP and OAS, and different account types, when properly coordinated, can drastically reduce how much you need to save.
So today, we're breaking it all down step by step. We will cover how to maximize your government benefits to cover a big chunk of your income, the smartest order to withdraw from your accounts to minimize taxes and clawbacks, and 3, how to structure your investments with the Canadian bucket strategy for safety and growth.
If you want to stop chasing arbitrary savings targets and instead retire with clarity and confidence, this video is for you.
So John, let's start with the foundation of most Canadian retirement income, and that's the government benefits you've already earned. That would be the Canada Pension Plan, CBP, and Old Age Security, OAS. Those programs together can provide a significant guaranteed income floor.
On average, a Canadian couple can receive over $3,000 per month combined from CBP and OAS. That's almost 30% of a $10,000 monthly retirement goal before touching a single dollar of your own personal savings.
Aha! But here's the catch. How and when you start receiving these benefits makes a huge difference. So for example, let's say you delay CPP until age 70, that can increase your monthly payout by up to 42% compared to taking it at age 60. That's literally hundreds more every month for the rest of your life.
So many people often rush to claim CBP early, often out of fear and financial necessity. But if you don't need that income right away, delaying CBP can be a more powerful financial move for you for your retirement plan.
Now, OAS starts at age 65, but it can be clawed back if your income exceeds certain thresholds. And this means that planning your income strategically is critical to avoid losing any of those benefits that you are entitled to.
Exactly. To minimize clawbacks, keep your RSP or RIF withdrawals low in high-income years. You can utilize your tax-free savings account to supplement income without increasing your taxable income. Or you can even blend your income sources carefully to stay under those certain clawback limits.
You should also check your CPP contribution history. If you had low income years or gaps, working a few extra years or contributing strategically can boost your CPP payout.
Don't forget, couples can coordinate when each spouse starts CPP to maximize combined benefits and your household cash flow.
So if you plan carefully and time it carefully, your government benefits become a stable, inflation-protected base that you can build the rest of your retirement income on.
Exactly. Now, once your guaranteed income is set, it's time to figure out how to generate the rest, usually the majority, of your retirement income.
But there is a common mistake. People often withdraw from their RSPs or RIFs first, without considering the implication from a tax perspective or government clawbacks. And this can lead to unnecessary taxes and reduced OAS benefits.
So instead, we recommend a blended bucket withdrawal strategy, which layers income from 3 sources. Tax-free income from your TFSA, which won't affect your taxable income or government benefits. Taxable income from RSPs and RIFs, withdrawn strategically before mandatory withdrawals begin at age 72. And then tax-preferred income from non-registered investments, specifically Canadian dividend-paying stocks that benefit from the dividend tax credit.
By blending these withdrawals, you can reduce your annual tax bill by $20,000 or more compared to withdrawing from RSPs alone.
The key tactics include starting RSP withdrawals earlier, but slowly, to reduce the size of your RIF and keep your income level and tax bracket lower over time, while also being able to utilize your TFSA to fill income gaps, especially in your years where you want to avoid old age security clawbacks balancing all three income buckets to keep total income below those certain clawback thresholds.
I think what we're after is trying to smooth out your income flow over your entire retirement, and you can avoid income spikes that trigger higher taxes or clawbacks.
So we've helped clients with around $1.7 million in savings stretch their money much further by carefully planning withdrawals year by year instead of just guessing.
Now that we have your withdrawal strategy in place, you need investments to support that plan. We use the Canadian bucket investment strategy, a time-based approach that balances safety and growth.
So here's how to break it down. Bucket 1 is cash or cash equivalents, enough to cover 12 to 24 months of living expenses. This acts as your safety buffer, so you don't have to sell investments in a down market.
Bucket 2. This holds income-producing investments like bonds, bond funds, or Canadian dividend-paying stocks to cover 3 to 5 years of income needs.
And bucket 3 is more long-term growth assets. Think some of the mutual funds, global equities, ETFs that provide growth potential but can also be volatile.
The strategy prevents panic selling during market downturns because your immediate needs are already covered in bucket 1.
And where you hold each asset matters for taxes. Foreign equities go in RSPs to defer withholding taxes. High growth or volatile assets are best in the TFSAs to maximize tax-free compounding. And Canadian dividend stocks and non-registered accounts benefit from the dividend tax credit.
Let's not forget rebalancing because it's essential. Each year, you top up bucket 1 by drawing down from buckets 2 and 3, locking in gains and maintaining your income floor.
The end result? A portfolio structured to generate reliable income, grow over time, and reduce stress during volatile markets.
So, now you have a clear roadmap to retire on $10,000 per month in Canada without needing a $3 million nest egg.
You've seen how government benefits cover a significant chunk of your income. You've learned how tax-efficient withdrawals can add tens of thousands to your bottom line. And you've discovered how a smart bucket strategy balances safety and growth. And you understand how realistic saving targets aren't necessarily tailored to you, it's to your general situation.
So, if you want help implementing this strategy, click the link in the description to watch our free training. We'll guide you through building your personalized Canadian retirement income plan.
Thanks for watching, and we'll see you in the next one.